Let me ask you a simple question. Why is it that some people work hard their entire lives, yet their money never seems to work back for them, while others reach a point where their money starts growing faster than their effort? That moment, when income stops depending only on your time, is not luck, it's a system. And today, I'm going to show you how to activate it. Wealth is not built by big wins or risky bets. It's built when money starts feeding on itself. What separates average earners from financially free individuals is one powerful principle called the snowball effect. At first, it feels slow, almost invisible. But once it gains momentum, it becomes nearly unstoppable. Today, I'll break down how this effect really works, why most people never experience it, and how you can set it in motion so that, over time, money stops being something you chase and starts becoming something that chases you. Most people never get past the first dollar because the beginning feels unrewarding. You put in effort, you save, you invest, and nothing dramatic happens. No headlines, no sudden lifestyle change. Just slow, almost invisible progress. That's why the first stage of wealth building filters people out. It demands belief before it delivers proof. When you earn your first dollar from an asset rather than from your time, something fundamental shifts. It may be a few cents of interest, a small dividend, or a tiny profit from a side venture, but its size doesn't matter. What matters is that this dollar was created without you trading another hour of your life for it. That's the moment you stop being just a worker and start becoming an owner. The problem is that most people judge progress emotionally. They expect motivation to come from results, but in the early phase, results come last. The snowball starts as a handful of snow. You have to push it manually, knowing that its weight is still too small to roll on its own. This is where discipline replaces excitement. You keep adding to it even when it feels pointless. At this stage, impatience is the real enemy. People abandon the process because they compare their beginning to someone else's middle. They see others earning thousands from investments and forget those returns were built on years of small, unglamorous decisions. The first dollar feels insignificant only because we are trained to value speed instead of sustainability. What most don't realize is that the first dollar contains the same DNA as the millionth. The mechanism is identical. The only difference is scale and time. Compounding does not suddenly appear later. It is working from the very start, just quietly. Every additional dollar added early has more time to multiply than any amount added later. This is why the first phase feels harder than it actually is. You are doing the most important work with the least visible reward. You are laying tracks before the train ever moves. Once momentum builds, effort and reward begin to separate. But that separation only happens for those who stayed long enough to let the process mature. If you can respect the power of that first dollar and protect it instead of dismissing it, you unlock a mindset shift. You stop chasing quick wins and start building systems, and that is how the snowball truly begins. Most people believe wealth is created by being smarter, faster, or more aggressive than everyone else. In reality, wealth is far more obedient to time than it is to talent. You can make average decisions and still win if you give those decisions enough years to work. But even brilliant decisions collapse when they are rushed or constantly interrupted. Time is the silent partner in every successful financial story. It compounds effort in a way no human skill can replicate. A modest amount invested consistently over decades will outperform a larger amount invested sporadically. This is uncomfortable to accept because it removes ego from the equation. It means the advantage does not belong to the loudest or the boldest, but to the most patient. The reason time is so powerful is that compounding is exponential, not linear. Early growth looks flat, almost disappointing. Later growth looks unfair. But both stages are part of the same curve. People quit in the flat phase because they expect progress to look proportional to effort. When it doesn't, they assume something is wrong. In truth, everything is working exactly as it should. Talent creates opportunity, but time creates inevitability. Someone who starts early with simple, repeatable actions gains a mathematical edge that cannot be caught easily. Each year adds another layer of growth on top of the previous one. What begins as a small advantage slowly becomes overwhelming. By the time it is visible, it is already too late to replicate quickly. This is why delaying the start is so expensive. Waiting for the perfect moment, more knowledge, or more money costs more than making a few small mistakes early. Time forgives minor errors. It does not forgive absence. Even poor early decisions can be corrected if the clock is still on your side. No strategy, no matter how sophisticated, can fully compensate for lost years. Patience is often misunderstood as inaction. In reality, patience is disciplined consistency. It is showing up, adding to the system, and then allowing time to do the heavy lifting. The hardest part is trusting a process that rewards you long after the work is done. Those who understand this stop asking how to get rich quickly and start asking how to stay invested long enough. Because when time is allowed to work without interruption, average effort turns into extraordinary results. And that is the quiet advantage that separates lasting wealth from short-lived success. Most people are taught to focus on income. Earn more, work harder, get promoted, add another stream. Income feels productive because it is visible and immediate. But income alone does not create momentum. The moment you stop working, it stops. That is the trap most people never escape. They confuse high earnings with real progress and wonder why wealth still feels out of reach. The real shift happens when you stop asking how much you earn and start asking what you own. Assets change the direction of effort. They store value, grow over time, and in many cases produce cash without requiring your constant presence. This is the line between staying busy and actually building something that lasts. An asset does not need to be complex or impressive. What defines it is simple. It either puts money in your pocket or increases in value over time. When income is converted into assets, effort begins to stack instead of resetting every month. Each decision builds on the previous one. That is how momentum forms. Many people stay stuck because assets feel slow compared to income. A paycheck is predictable. Asset growth feels uncertain, especially in the beginning. There is no weekly validation, no immediate feedback loop. That uncertainty pushes people back toward what feels safe, even if it keeps them running in place. The difference between income thinking and asset thinking is control. Income is dependent on external approval, a boss, a client, or market demand for your labor. Assets work under a different logic. Once acquired, they operate whether you are present or not. They do not care how you feel, how motivated you are, or how many hours you put in that week. This does not mean income is unimportant. Income is the fuel. Assets are the engine. Without converting one into the other, progress remains fragile. A single disruption can undo years of effort. With assets, setbacks slow growth but rarely stop it entirely. When this shift happens, behavior changes. Spending decisions become strategic instead of emotional. Short-term comfort is weighed against long-term ownership. The question moves from, "Can I afford this?" to, "What will this cost me in future growth?" This is where the snowball gains structure. Income starts the process, but assets keep it rolling. And once that engine is running, money no longer depends solely on your time. It begins to depend on your decisions. Most people believe growth comes from making more money. In reality, growth comes from what you do with the money after you make it. This is where the snowball either accelerates or completely stalls. Reinvesting is the difference between progress that feels stuck and progress that suddenly feels alive. When returns are small, the temptation is to treat them as rewards. A little profit feels earned, so it gets spent. That decision feels harmless because the amount looks insignificant. But early gains are not meant to improve lifestyle. They are meant to increase capacity. Every dollar taken out too soon reduces the size of the next cycle of growth. Reinvestment works because it compounds effort, not just capital. The same system that produced a small return now operates on a larger base. Nothing new needs to be invented. No additional risk needs to be taken. The only change, is scale. This is why reinvesting is such a powerful accelerator. It lets existing momentum multiply instead of reset. This phase requires restraint more than ambition. The biggest threat is success arriving too early. Small wins create the illusion that the process is complete. In reality, those wins are signals that the system works and should be fed, not consumed. The discipline to delay gratification is what separates those who experience steady growth from those who plateau. Reinvestment also changes how risk is perceived. When growth is fueled by profits rather than fresh savings, decisions become more confident. The snowball begins to fund itself. Losses feel less personal, and gains feel more strategic. This emotional shift matters because fear and overconfidence both distort judgment. Reinvesting creates balance. Over time, the effect becomes visible. Growth starts to feel faster, even though the actions remain the same. This is not because the strategy improved, but because the base expanded. Each cycle now produces more than the last. The curve begins to bend upward, and patience finally gets rewarded. What most people never experience is the compounding of reinvested returns over long periods. They interrupt the process just as it is about to show its real power. They extract value instead of multiplying it. The snowball remains small, not because the system failed, but because it was never allowed to mature. When reinvesting becomes automatic, progress stops depending on motivation. Growth becomes structural. Money begins to stack on top of money, and the snowball no longer needs constant pushing. It starts pulling itself forward. Momentum is fragile in its early stages. The snowball can grow steadily for months or even years, and still be destroyed by a few common mistakes. These mistakes rarely look dangerous in the moment. They feel normal, justified, and often even responsible. That is what makes them so effective at killing progress. Debt is the first silent destroyer. Not all debt is dramatic or reckless. Most of it is socially accepted and neatly packaged as convenience, but debt reverses compounding. Instead of money working for you, your future earnings are pledged to past decisions. Interest does not wait for you to catch up. It compounds daily, pulling the snowball apart faster than you can rebuild it. Even strong income cannot outrun consistently negative momentum. Lifestyle inflation is more subtle and far more common. As income increases, spending quietly expands to match it. There is no single bad decision, just a series of upgrades that feel earned. The problem is that lifestyle inflation captures surplus before it ever becomes growth capital. The snowball never gets heavier because excess is redirected into comfort. Progress looks like movement, but ownership stays flat. Emotional investing is the third and most dangerous force. It turns markets into mirrors of fear and ego. People buy when excitement is high and sell when anxiety peaks. Logic is replaced by headlines and social proof. This behavior does not just reduce returns, it breaks consistency, which is the foundation of compounding. Every emotional decision resets momentum. What makes these three forces so destructive is that they feed off each other. Debt increases pressure. Pressure fuels emotional decisions. Emotional decisions lead to losses or panic, which then justify more debt or spending for relief. The cycle tightens while the snowball shrinks. Avoiding these traps is less about intelligence and more about structure. Systems that limit impulse matter more than willpower. The goal is not perfection, but protection. Growth does not require constant optimization. It requires removing the leaks that drain progress. People often believe wealth is built by taking bold risks. In reality, most wealth is preserved by avoiding predictable mistakes. The market does not need to be beaten for the snowball to grow. It simply needs to be allowed to work without interference. Those who reach the tipping point are rarely the most aggressive. They are the most consistent. They protect momentum with boring discipline and quiet rules. By the time results are visible, the hardest work has already been done. The snowball survived long enough to become too heavy to stop. There is a moment in every long-term wealth journey when something subtle but powerful changes. Progress stops feeling forced and starts feeling natural. Growth no longer depends on constant effort or motivation. The system you built begins to carry its own weight. This is the tipping point, and it is where most people finally realize why the early years felt so demanding. Before this stage, every contribution matters. Every decision feels heavy because the snowball is still small. But once enough mass has accumulated, movement becomes easier. Returns are no longer just a result of new input. They are increasingly driven by what already exists. Money begins to create more money at a pace that feels surprising, even to the person who built it. This moment often arrives quietly. There is no announcement, no dramatic milestone. You notice it when growth continues even during periods of reduced effort. A missed month does not derail progress. A market setback slows things but does not reverse them. The system has resilience. It absorbs shocks instead of collapsing under them. What makes this stage powerful is psychological relief. Pressure decreases. Decisions become clearer. You stop chasing outcomes and start managing a process. Risk is no longer about survival, but about optimization. This shift changes behavior. People become more patient, more selective, and less reactive. Confidence is no longer borrowed from short-term results. It is anchored in structure. At the tipping point, time becomes an ally instead of a threat. Earlier, delays felt costly. Now, patience is rewarded. Growth over a single year can exceed what took many years at the beginning. This is not because effort increased, but because compounding finally has enough scale to reveal itself. Many people misunderstand this phase and assume it is the result of a single smart decision. In truth, it is the accumulation of thousands of ordinary ones. The tipping point is not reached by intensity. It is reached by endurance. Those who quit early never see it, which is why it feels rare and exclusive. Once this stage is reached, the goal shifts again. It is no longer about proving the system works. It is about protecting it. Growth becomes less about speed and more about sustainability. The snowball is now large enough to roll on its own, but it still requires direction. This is when money truly starts making money. Not occasionally, not theoretically, but consistently. And by the time you recognize it, the hardest part is already behind you. If there is one idea I want you to walk away with today, it is this. Wealth is not built in moments. It is built in motion. Slow at first, almost invisible, and then powerful enough to change the direction of your life. The snowball effect is not reserved for the lucky or the gifted. It rewards those who respect fundamentals, stay consistent, and allow time to do what it has always done best. You do not need perfect timing, secret strategies, or extreme risk. You need patience, structure, and the discipline to keep moving when progress feels quiet. Most people never fail because they choose the wrong path. They fail because they stop too early. They interrupt the process right before momentum takes over. The difference between those who struggle and those who succeed is rarely intelligence. It is endurance. From this point forward, measure progress differently. Stop asking how fast results are showing up and start asking whether your system is still intact. Protect what you build. Feed it. Give it time. Because once the snowball is large enough, effort and reward separate. Money stops being something you constantly chase and starts becoming something that works quietly in the background of your life. That is when financial stress fades. That is when options expand, and that is when you realize that the most powerful wealth strategy was never speed, but staying in the game long enough for compounding to take over.